Basically agree with Mike's point. We think it's too early to say it's the end of the bond bull run, if you will. Now, I'm not going to come out here and say the 10-year Treasury yield's going to 1%, but something like 2% sounds too high to us. When you look at our fair value model, for instance, it'll tell you the 10-year should be around 150. Now, I think I can make a pretty good case for 170, 180 without much difficulty at all. These may seem like small increments, 20 or 30 basis points, but again, we don't see the 10-year yield going up to 250 or 3% anytime soon. We agree the Fed's going to keep very fully engaged for the bulk of this year, maybe all this year in QE. So too early, bottom line, to say the bond run is over.
So let me stay with you, UBS. What will you be looking at to tell you that it's time to get out or at least lighten up?
I keep hoping somebody rings a bell, but I suspect that won't happen. So barring that, a couple of things. Number one, what do our clients tell us? What do the big investors out there tell us really in terms of their thoughts on positioning, critical levels, et cetera? That's the first thing. Secondly, economic growth. UBS's call for growth is a bit more bullish than Barclays. We're looking at, call it 2.2, 2.3% real growth for the U.S. for this year. Decent numbers, certainly not great by historical standards, but not so bad. And also when you think about political risk, we think that's been a big factor, perhaps the biggest factor keeping rates low for a long time. As that hopefully starts to diminish in the U.S., we think that's going to be a sign rates will go up.